Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending May 15, 2026. Another week that was quite busy on the geopolitical front, but this week it was about President Trump's visit to China. We were looking at maybe potential announcements on AI or whatever. We didn't get much in that way, but we did hear about the stark warning from the Chinese President Xi, who warned Donald Trump about, treading carefully on Taiwan because the U.S. is selling arms to Taiwan, and they wouldn't want this to become a point of contention between the two. So that was a stark warning. Markets didn't react to that, but still that did set the tone for a meeting of equals here. Other than that, we have now a new president at the Fed. It's Kevin Warsh. He was nominated officially, and he went through all of the votes on the week. So we will be starting today on May 15. This is the last day of Jerome Powell's tenure. We'll dig into that in a few minutes. Other than that, if we look at the markets at the close on the week, negative for bonds. Seeing that I'm always repeating the same thing with bonds, but negative for bonds on the week. The TSX up, stock market up. But as I am recording this review, it's early in the morning. Markets are not open yet, but futures are pointing towards pretty much an unwinding of everything that you see here. So we are likely to see something that is much more neutral by the end of the day if the trend that I'm seeing on my screen here continues. But since the beginning of the year, emerging markets first, NASDAQ, S&P 500 now in the second place. Of course, remember that we were very vocal about investing in global ex-US versus the US. Emerging markets are still in agreement with our view here. But recently, as I showed last week, we have flipped to an overweight in the US, mostly because we thought that the gap in valuation was maybe a bit overdone here. And also because the AI trade, we feel, is still very conductive and very interesting for the next few months, quarters. We'll dig into that in a few minutes. So there's good reasons here to not give up on the US. So we did favor global ex-US, but US is still an interesting destination. And, markets are starting to tell us that. Oil up 6% on the week. Canadian dollar, euro down, and price of gold, pretty volatile these days. Now, the story of the week was U.S. inflation. So we had CPI coming out early in the week, jumping all the way to 3.8%. So we're just about to hit 4%, and we will hit 4% next month. It's pretty much a mathematical certainty that we will. And this will make things complicated because the next CPI report will be out just a few days before Kevin Warsh's first decision as a Fed chair. And of course, you have to guess that behind closed doors, he did, sell on Trump the idea that he would be able to cut rates. That's going to be pretty hard when he comes in. The other data that we got this week is PPI, so Producer Price Index. So of course, this is a leading indicator of CPI because businesses face higher costs in producing, and then of course they pass on the bill to consumers. And to see the PPI jumped to 6%, and expectations were for 4.8%. So that tells you how inflation is back, and it's dangerously back. We added another measure here in that chart. It's the trimmed mean CPI. We're not getting fancy here. It's just that Kevin Warsh himself, during his nomination process, was pretty vocal, saying that he preferred this measure, maybe because it was the lowest of the bunch and it allowed him to spin his narrative that rate cuts were made sense. But even this measure just jumped on the week to 2.8%. So it's just about to cross. It's likely to cross the higher bound of the range between 1% and 3%. So, that's a very inflationary picture, and the trend is alarming here. So this is where we stand. And now that Kevin Warsh confirmed as the Fed and the next Fed chair, now markets are trying to price things in. And the chart on the left that you see here is what's pricing for every meeting. So the odds that there is any change in the first few meetings from with Kevin Warsh as Fed chair are close to zero. But by the end of the year, now it's one half of the hike that is priced. You have to think that it's going to be higher than that at some point because you have an economy that is still pretty hot. You have inflationary pressures that are evident and they are brewing and they are growing. You have the capex cycle that is keeping the economy pretty warm. So there's many reasons here why you could argue that rate hikes might be useful, or at least they should be priced. And Kevin Warsh was very vocal against guiding the markets too much of the communication style and the forward guidance. But the playbook that we shared in our latest monthly shows that you need to use forward guidance in environments like these when you have a supply shock, which is causing some issues with the economy, slowing the economy down. So if you hike rates, then of course you tackle the inflation problem, but you can worsen the growth problem. So that's not that's a complicated environment. So forward guidance is very useful now. So let's see how Kevin Warsh navigates through that. And on the right is the balance sheet of the Fed. It has been picking up slightly recently, mostly for technical reasons. There's more liquidity in the economy, so that means that there's more deposits in banks, so more banks reserves. So I don't think that the Fed is just is doing an about face now, but the bar is high for the size of the balance sheet to come down as much as Kevin Warsh would want. So always be careful what you ask in life because you just might get it. Well, Mr. Warsh wanted to be Fed chair. Well, welcome. Mr. Warsh is going to be an interesting ride. Now, a chart not from us, from Goldman Sachs here, for just full disclosure, but to show the risks and opportunities around AI. So AI is, of course, is the dominating theme, and it will be the dominating theme for years to come. And there's two things here. There's risks and opportunities. Focusing on the risks here. So this is a forecast from Goldman Sachs, but I've seen that left and right. So pretty much the industry consensus now that if AI adoption in businesses in which you use or what we use, if they come to fruition, the demand for tokens, so units of calculation in data centers, should rise by a factor of 24 times by 2030. So in the next 3.5 to 4 years. So times 24, that's a lot. And what we do know is that data centers now are fully used in full capacity. It's not like in 2000 when we had overinvested in fiber optics and it was just 2% of the network capacity that was used. Now it's 100% or close to 100%. So basically, there is no way that in the next 3 to 4 years, we multiply the capacity of data centers worldwide by a factor of 24. So there's going to be some scarcity. That means that some models will be temporarily unavailable. There's going to be access issues, but mostly, as everything macro, it's always about the prices, relative prices. So prices will adjust to balance this market. This is how the world works. So what that means is that, yes, access to tokens will be limited and the price of tokens will be rising quite a bit. So that will delay the adoption of AI in the scale that you see here. So likely it's not going to be the times 24, is going to be less than that to balance the market. But that also means that now there's lots of pricing power for hyperscalers. And that means that profitability in the sector will be favored quite a bit. So there's a risk that AI will be adopted much more slowly because it seems like no one is factoring the very important aspect of things, which is prices in those forecasts. So slower adoption, but pricing power means that investing in the AI trade is likely to be very profitable again for a long while. So very interesting juncture here. We'll keep following that, but this is likely to be one of the determining factors for the growth, productivity going forward, the state of the labor market, and of course, financial markets. So very interesting time to be alive here. What we'll be watching next week now, Canada CPI inflation. The forecast is that will jump from 2.4 to 3%. That's a solid jump. But Canada's backdrop is not as inflationary as in the US, so it's not likely that the Bank of Canada follows the Fed and has to think about hiking soon. But of course, you have to put a non-zero probability on that. So we'll see what comes out next week. Retail sales as well will be out. And in the US, FOMC meeting minutes from April 29th. We'll see how the Fed is trying to guide the markets for what's to come. S&P Global PMIs and Confidence Index from the University of Michigan will also be out. So it's always a pleasure to serve you. If you appreciate the content here, please share. And of course, come back next week.